Hello, everyone, and welcome to our K-1 Pass-Through Entity Series. I'm Dave Stauffacher, the Senior Credit Training Officer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. My colleague and Senior Credit Trainer with Lenders Online Training, Joe Davis, is joining me today. Hi, Joe. How are you doing?
Good, David. Good to be back again. Thank you.
Awesome. Welcome. You know, Joe, we have yet another question from our viewers. This is excellent for our K-1 series. Yes. So the question is, how should I factor in loans from owners or their repayment? Now, I might need to define some context here. I'm going to say owners can actually lend money to their company if they wanted to as an entity, but the entity actually can lend money to the owner as well. So we're going to concentrate primarily from the loans from the owners to the company. Let's do it that way. So if you've been following Lenders Online Training, like many of you had, you know that there's just no one-size-fits-all solution for any type of loan, as well as banks. And we kind of do have our opinions. Right, Joe?
we certainly do. Certainly no one size.
No. So, Joe, let's talk.
Yeah, of course. So let's start with how we find out about the loans.
Great.
So the loans from the company to the individual, or excuse me, loans from the individual to the company, as you just said. And then after that, we can kind of talk about, all right, what do we do with them? But loans from the owners, so think partners, LLC members, or shareholders, will show up on the Schedule L of the balance sheet of the 1120, the 1120S, or the 1065. So that's the schedule that shows the balance sheet. You should be able to see that there. But keep in mind, if the entity is fairly small, you're not going to get a Schedule L. In another live stream and also in our foundational credit training, we cover the overview of these returns. We talk about when you will and when you will not get a Schedule L or the Schedule Ms, which is really unfortunate because even if it's a really small entity, you're going to want a balance sheet. You're going to want that detail. But sometimes you're not going to get it. You'll have to get it a different way. Okay, so what you can do, though, is get a debt schedule. So if you don't have that balance sheet, or maybe you want more detail, you get a debt schedule. Okay, it's just exactly what it sounds like. It's a schedule of all the entity's debt. You should be able to see that owner's debt on there. I like to get one anyways. It's not typically part of your standard reporting package. You're going to have to ask for it. It's not a tax return attachment or anything like that. It's often just written in Excel and shows some detail. That's a really good step that people can take. But also, you can and should just talk to the borrower and just figure out what they have going on in those initial discussions and the continuing conversations you have with them. So let me give you an example. So if the company is starting out, or if they're expanding, they're growing, okay, how are they financing that? You know, as we know, sales requires cash. So where's that cash coming from? It can come from a few different places, right? It can come from owner loans, which is what we're talking about right now. It can come from owner capital contributions. So that's the owner injecting funds into the company, typically cash. Maybe it's something like capital gains. Maybe they sold some things to generate cash to buy other assets. We don't typically treat those gains as recurring, but it's still cash. So there can be a few different ways that they're generating that. It also could just be, hey, we're making money, so we're using our cash and our cash flow in order to buy assets. But that first one that I mentioned is the big one that we're talking about right now. Is the owner loaning money to the organization? Now, if the owner is a guarantor, you have a lot more information, a lot more data points that you can use. You have a personal financial statement. That personal financial statement should show as an asset. It should show as an asset the loan, to the company. Okay, so that's a good place to look for that. Also, if they're receiving payments on that debt, you should see the interest income, so the interest portion of that payment, on the Schedule B of the 1040 tax return, so the personal tax return. So there's a couple places that you can look if you do have that personal information. But if they're not yet getting payments on that debt, so they loan the money and they're not getting regular payments, you're not going to see that. So you have to use one of these other methods that we're talking about in order to figure out how much the debt is, what the payments are, and that sort of thing. So, David, that's some ways that we would find out about the debt, but what do you recommend we do with it after that?
I want to touch a little bit of as far as finding out a little bit of the debt with regards to it's kind of like in most cases, it's kind of a little investigative work, right? We're looking at maybe a personal financial statements, and I apologize for chuckling, but in all my years in banking, and quite honestly, even when I'm a consultant, the personal financial statements are usually uniquely filled out, right? They're they're filled out from the owner's perspective, right? And um, most of them are not maybe CPAs by discipline, so they fill it out of what they think the values are. Oftentimes, you will see life insurance that has over $1 million when it's really cash value, or they'll have company debt on their personal financial statements, but they won't have they'll have the company assets, but they won't have the debt. Sometimes they'll have the debt, they won't have the assets. So you're always trying to maybe consolidate. You're trying to evaluate not only from the personal financial statement, maybe our own company files, if they happen to be a customer of ours. We may find for the credit bureau, and then we will ask them for a debt schedule, which I have done most often, and not everything is included on that. So you try to have to put it all together. So we want to have an overarching view as to, okay, what do they have? And quite honestly, even if they have lent the company money, it's very rarely do I see that on a debt schedule. They just put it in there. And a lot of times they lend money to the company, oftentimes because the CPA believes that's a good strategies to do that rather than putting it in capital. We bankers see that all the time, right? And it's sitting there. But yeah, it's interesting. So what do we do with all that information? We have it. So let's try to put it in the context of underwriting. First of all, we'll deal with the percentage of ownership. Let's say the owner is 100% owner of the company, or he and his wife own the company. So they have complete control over company's checkbook. Basically, they can determine when they get paid back. So it's a little bit flexible on that. If you were a less than lower percentage, maybe less than 25, maybe 10%. So you are truly a minority owner. If you're lending the money back, you don't necessarily control the checkbook. So there's a little less flexibility involved with that. The other thing I would focus on is repayment history. Is the company paying the owner back consistently year after year? Or are they just paying interest? If they are, Joe mentioned it was going to be on the Schedule B, but are they or not? If they are, then we have a little bit of a comfort as knowing that that's going to be not only from a historical perspective, but is it going to be recurring, happening year after year? Now, we would want to know, we'd probably ask for a note if they actually have noted on the balance sheet that it is a loan to the company. I'd like to know the terms. Maybe a copy of the note. Is it going to be paid off sooner than later? If it's going to be paid off sooner, well, that's kind of worth considering, right? If I'm paying off my loan to myself, the company is, and then the loan is paid off, the company's got extra cash, right? So if I'm the owner, would I want to still get that extra cash out maybe as a distribution? Could, never know. So it's kind of just knowing more to the context of what's going on. So this is me this is going to be an underwriting geek. This is what I'm going to focus on is why does it matter for credit analysis? Kind of a slight detail from the tax return analysis is it's a liquidity signal, right? If the owner of the company is injecting money into the company for a loan, does it signal that maybe the company is maybe they're expanding, maybe they're struggling? I mean, just a few years removed, we had COVID. Some companies were struggling. And I recall a couple of companies that I've worked with, they were fortunate enough to lend money to the company. Now they lent the money in. Now they didn't take salary during that time, but they provided in as cash. They didn't do it as equity per se, but it was a loan. So as time goes on, the company paid themselves back. Then eventually they got into some distributions. The other reason if I was an underwriter, repayment risk. The company is paying me back. Are they paying the lender too? Oftentimes we will have standby relationships where you say, well, you have to pay us back, but you can't pay yourself back yet. So we want to be aware of that as far as how much debt is going out of the window. And likely, if we mentioned before, if I'm putting in money as an owner to the company instead of capital, a bank, I know the SBA considers, we'd like that subordinated. We'd like the position of repayment to be behind us. We want us to, we want to be paid first before the owner. So, like I said, I recall a lot of situations during COVID where owners needed to help fund the company a little bit in addition to the special programs that are out there. Because sometimes even in recessions, not necessarily COVID, there are ups and downs, and owners committed to their business will lend it some money, but they want to get repaid back. So we just need to be aware of that. A lot of examples. There are no hard, fast rules. Sometimes your guidelines will give you some insight as to what information we want, but as a prudent underwriter, those are good questions to ask to make prudent loan decisions, know where the cash flow is coming in, coming out. So, Joe, anything to add?
I think you covered a lot of really good points on that. I would underscore a couple of things that you said. One, these debts are often informal. They're often not documented very well. They're often more flexible than bank debt. Bank's not going to say, "Oh, just pay us when you get it." The owner debt, that can be a little bit more flexible. You also kind of touched on, well, why does it matter? I mean, if it's just money from the individual to the company and vice versa, we have a personal guarantee. Why do I care? Well, you care because it's a lot easier to exercise your rights on the borrower than it is on the guarantor. Okay, personal guarantees are valuable and they're meaningful, and we take them for a reason. But if you ever have to exercise that and go after that personal guarantor, it's going to be expensive, and you might not get to it. So you want your borrowing entity to really succeed. Many small business owners don't really distinguish between their personal finances and the company's finances. They are the business and the business is them. So uncovering this detail can often be a bit of a process, as we've talked about today. But for the banker, determining the financial strength of the borrower versus the personal guarantor is just fundamental, right? This is what I'm talking about. So this also underscores one of the reasons why we require personal guarantees in business banking and small business banking. Funds can flow rather freely between those entities. And so, really understanding who's getting what, who has what is really fundamental to what we're talking about.
Awesome. Great points, Joe. Appreciate it. So there you have it, everybody. How should I factor in loans from owners and their repayment situations? If you need a better understanding of how the K-1s for each entity type that we deal with fit into the mix, our entire live stream has many perspectives on that, basically centered around questions that you have submitted to us. If you need some foundational training, it makes sense of all this stuff, gain some confidence in your ability to underwrite loans, whether it's you yourself, whether it's your junior staff members, maybe it's your team in general, reach out and give us a call. Lenders Online Training/talk. We'd love the opportunity to chat with you and tell us a little bit more about what we can do with you and help your organization. As a final reminder, I've always said this, we love to hear your comments, your suggestions, much like today, a question from one of our viewers. Thank you very much. I appreciate that. Feel free to contact us at experts@lendersonlinetraining.com. That's experts@lendersontraining. So until next time, appreciate you all for coming. So have a great day, everybody. See you later. Bye.
Thank you. Bye-bye.